If you recently inherited a home in California, or you think you might in the next few years, there's something you absolutely need to know about. In 2021, a law called Prop 19 rewrote the rules on property taxes for heirs. And if you make the wrong decision within the 12 months after the parent passes, your property tax bill could be 3 or 4 times higher than what the parents ever paid. Hi, I'm Lisa Bognuda and I'm with eXp Realty here on the California Central Coast. I help families buy, sell, and figure out what to do with real estate, and inherited homes come up more often than you would think. If you're new here, hit my subscribe button. I put out content specifically for the California Central Coast market. In the next few minutes, I'm going to break down exactly what Prop 19 changed and what your 3 options are as an heir, and one of the tax benefits most people completely miss. So let's get into it. Here's the background. California has something called Prop 13, which caps how fast your property taxes can increase every year. If your parents bought a home on the Central Coast in 1985 for, let's say, $150,000, they might be paying taxes on an assessed value of around $200,000 today. And that is even if the home is now worth $900,000. Before 2021, their kids could inherit that home and keep the low property tax base. Whether it was the main residence, a rental property, or a vacation home, it didn't matter. That protection transferred to the child. When Prop 19 went into effect, that ended. Now, the parent-to-child tax protection only applies to the primary residence, and only if the child moves in and makes it their primary home within 1 year of inheriting it. If you don't move in, the county reassesses the property at full current market value. On the Central Coast, that could mean the difference from the previous tax bill at $2,400 to now more than $10,000. Let's look at your options. So, option 1, you move in. If you want to live in the home and you can establish it as your primary residence within 12 months, this is usually the strongest financial move. You can keep the parent's assessed value with just one caveat. If the current market value is more than $1 million above the assessed value, the difference above that threshold gets added back in. So in this example, if the home is worth $1.4 million and the assessed value is $200,000, your new assessed value would be $400,000 on that $1.4 million. So it's not the full $1.4 million. This is still way better than a full reassessment, but it's still not zero. So let's look at option 2, you sell. Selling is often the smartest move financially, and most heirs don't realize it. When you inherit a property, the IRS resets your cost basis to the fair market value at the time of your parents' passing. This is called step-up basis. So if your parents paid $180,000 in 1992 and the home is worth $900,000 when they pass, your basis is $900,000. If you sell shortly after that, you could only owe a little or no capital gains tax on the sale. In a market like the Nipomo or Orcutt, where well-maintained homes sell quickly, this can be a clean, profitable exit for the heir. Now let's look at option 3, keeping it as a rental. You can do this, but go in it with real numbers. There's no Prop 19 protection for the rental, and the property will be fully reassessed. So on a $900,000 home, you're looking at roughly $10,000 to $11,000 per year in property taxes alone. That's before insurance, maintenance, or vacancy. Run the actual cash flow math before deciding. A lot of families assume they can hold on to the home and collect easy rental income. Sometimes the numbers work, sometimes they don't. And finding out after the fact is very painful. Whether you're leaning towards moving in, selling, or renting, here's what to do before you make any decisions. 1, talk to a CPA who understands the California property tax and step-up basis. This is not an optional step. Step 2, get a title review. Find out how the property is held and whether you need to go through probate. Just a note, in California, probate can take 6 months or longer. And step 3, know what the home is actually worth today. Not what Zillow says, a real valuation for someone who knows the local market. Step 4, If you're thinking about renting, run the numbers using the reassessed tax rate, not the parent's tax bill. And finally, step 5. If you're considering moving in, remember you have 12 months from the date of transfer. The clock doesn't pause for probate delays or family discussions. If you've inherited a home on the California Central Coast, or you're helping a family member work through this, just remember, I'm happy to walk you through all of your options. You can reach me at the link below in the description. And one thing to keep in mind, nothing in this video is legal or tax advice. Every situation is different. Please talk to a licensed CPA and real estate attorney before you make any decisions about the inherited property. If this video helped you, hit the thumbs up. It helps other families find this information when they need it. I'm Lisa Bognuda, and I'll see you on the next one.